Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, the stock market marches into a new month, so to speak. What lies ahead? We'll find out the answer to that question and others here at the Roundtable with our editor-at-large, Steve Reitmeister, research director, Shiraz Mian, and market technician, Kevin Matris. Like that little pun that I opened up with? Market marches in.
We're springing into...
Will it be a lion or a lamb? I don't know. One thing, though, that I saw on the wire this morning is this whole question of confusion over, are we in a true correction, or are these just little market tremors that we've been feeling for the past 2 months here? The true correction being defined as a drop of 10% in the stock market. Can we call corrections true corrections anymore? Are they going to take on their own characteristic patterns every time we have one?
I think that what we saw when we fell from like 10,700 to 9,850 intraday low on the Dow, that's pretty close to 10%. So that's like 9%, and that's close enough. So that definitely has some people scared, especially when it fell under 10,000. There was definitely some question marks. You saw a capitulation and it rise back up. So I think that was a healthy correction that had people questioning their convictions, whether it's a rally or not. So I think we did have one, and I suspect that we'll have others in the future.
So, Kevin, as a technician, would you think that any rise in interest rates here going forward would trigger any bigger correction, any more exacerbated correction than what we've been seeing?
Well, that's the thing. I don't think we're going to see a rise in interest rates. I don't think we're going to see a rise in interest rates probably for at least a year or more. But yeah, this 10,000 area seems to be kind of like a magnet. It goes below there and then it immediately goes back up. The market gets above 10K and then it can't really get any traction and then it kind of falls back down. Mm-hmm. I still think that we are going to be confined within this range between 10.4 and 10.5 on the upside, and then you've got that psychological 10 on the down, and then you have that 200-day, which is right around 96 or 97. So the market is looking for a catalyst. So far, there's been plenty of negative catalysts that have not been able to break the market down, but again, the market is looking for something to give it an excuse to break out in one direction or another, and for right now, we just keep on trading back and forth.
And at this point, is it anybody's guess what that catalyst may be?
To be honest with you, I think if we can just have an absence of less bad news and actually get some good news, then I think the market will finally feel emboldened to be able to break on out to the upside. But if we do get a surprise with some really horrible, crummy news, then it's anybody's guess, and we could retest that lower 10K area.
So having said all of that, Shiraz, are you looking at the market here and from the investor's perspective as stocks having more upside potential than downside risk, or vice versa?
In general, given the level of certainty and visibility about the economy, I would characterize valuations as fair. I won't necessarily see a significant downside risk or very significant upside potential from here. My sense is that once we get visibility and clarity on the labor market, on the consumer, on the direction and flow of the economy, that will give investors and the market in general more clarity as to which direction to go. Look, the growth and the gain that we had last year was as a result of the market getting convinced that we are not getting into a Great Depression 2.0. Mm-hmm. If we get any sort of clarity of that magnitude, obviously there's no such issue of that magnitude on the horizon right now, but if we remove some of these uncertainties from the market, that will provide us a stimulus for the upside. Absent that, I don't really see the market moving in any specific direction for an extended period of time in any way. I see the market oscillating and moving around in a range-bound fashion throughout the year.
And with Snowmageddon happening up in New York lately, I don't even know how they've been making it into trade on some of those days, but...
Yeah, I mean, the range bound is a good thing until there is some catalyst. I think that is very true. It's there's things on either side. Okay, let's just say that I agree with Kevin that the lack of bad news is what will keep us going higher. I mean, the lack of bad news in the economy just slowly and steadily rolling in a positive direction, that will be what makes people feel better. But here again, the risks, there are tremendous risks to the downside. But here's the funny thing is, there's about 10 to 20% likelihood that everything goes back in the toilet as we saw. Seriously. Okay, but it's only 10 or 20% likelihood that that's possible. And yes, the market will come tumbling down. So there's an 80 or 90% likelihood that we avert that and we keep going in a positive direction where the market gains 5 or 10% a year, which is a reasonable rate of return. But that's the funny thing is 5 to 10% upside, 80% likelihood, 10 to 20% likelihood that goes down 30%. Okay? Or 40%. Okay, that's a scary balance, and that's why the market sits where it is now, given those range of factors.
So might shareholders then, in order to make up some extra return for themselves, be looking more toward dividends?
There's a lot of folks doing that because, right, if the market averages are not going to go that high this year, which is, I think there's a consensus moving in that direction, that it's not going to be big changes for the index, then yeah, absolutely. That's a good place in which to get some return this year. I'll say for myself that I picked up the ETF of IXP, which is the International Telecommunications ETF. And that's giving a 4.3% dividend. So a very stable kind of business and a 4.3% dividend. I felt that for the conservative portion of my portfolio, that was a good place to be. Yeah.
Either of you two guys looking at any sectors or stocks in particular that you might want to take note of?
I would just second this dividend play idea in the context that it gives you typically exposure to companies that are mature, that are stable, that have strong cash flows, and a stable business profile. And you need exposure to investment ideas like that in a relatively uncertain environment like the one we are operating in right now.
All right, we had a very mixed week last week of economic news come out, raising concern maybe about a double-dip recession being rekindled. Kevin, are you worrying about a double dip?
No, I'm not really worried about it. I know everybody keeps looking at the consumer confidence and the consumer sentiment, and I think we've talked about it before. And I think people focus on it only because 70% of the economy is tied to the consumer. But the one thing that's interesting is that the current conditions component continues to outperform better than the expectational component. But what's interesting is that it seems like month after month after month, the current conditions component continues to improve, which is opposite if everybody's negative view of the future was really going to be as bad as they thought it was. So that's kind of ironic, but I believe that the consumer continues to show their resiliency, and I really don't think that that there's going to be any kind of double dip because the consumer still continues to stay present.
Well, consumer spending showed a little bit of a gain here in January, 0.5 percentage point. So if that's any indication, that may be something that we'll have to keep our eyes on. Maybe the consumer is not dead yet.
Right, not yet.
You say that as though it may be somewhere down the future. Right. Thank you all for joining us. We hope that your week ahead is a profitable one. That's the latest thinking from here. And with all these guys, I'm Terry Ruffalo.